Hi there. Should you invest in Dish, a company that has 2 billion market cap and the price to earnings is around 2? They are making over 15 billion revenue, and if you look at their assets, you can see their total assets are over 50 billion. So when you compare their assets of about 50 billion to their market cap of only 2 billion, you will say this is a bargain. Last year, in 2022, they made of about 2 billion in earnings. And that's amazing at the current market cap of about 2 billion. As you can see, the stock price has declined by over 90% from its peak. Moreover, they also have of about 1.1 billion in cash. So this is half of their market cap, and that's great. And the market expects the revenue to be stable in the future. So when you look at this company, you might say this is a real bargain. I've also got more comments about this company to analyze it. So that's why I'm making this video. And in this video, we'll find out if Dish Network Corporation is a great buy at the current price of $3 or almost $4. Let's begin the analysis. First, if you look at the revenue, their past revenue, and the estimates, what the market expects, you can see that the revenue was of about 16 billion last year, 2022, and it is expected to decrease this year and next year's, but then a small increase. So you can expect that the revenue may be around 15 billion a year. Now, if you look at their profits and also their free cash flow, you can see a huge decline. The earnings are expected to decline from 2 billion to a loss of around 14 million. So that's a huge drop in their earnings. And also their free cash flow. As you can see in 2022, their free cash flow has declined from almost 2 billion to more than 7 billion. That's huge. Now, if they can turn this business around to deliver positive earnings and free cash flow, then also the stock price will rebound. You might have a return like this, over 400%. So you can easily more than quadruple your investment if Dish delivers positive earnings. Now, don't rush to invest in this company, because there are the things you have to know. First of all, if you look at their segments, you can see that the number of subscribers is going down for both segments, pay TV and wireless. By the way, if you want to know more about those segments, you can pause the video and read the description, what they are doing. In short, they have a satellite network where they provide pay TV services and wireless services. They bundle more services and offer different subscriptions. For instance, if you want 190 channels, you pay of about $85 per month. And the more you want, the higher the subscription will be. I don't know who wants to pay this high amount, but as you can see, they have some subscribers of about 8.8 million for pay TV, and for wireless services, they have of about 7.5 million. But if you look at the longer period, you can see that the number of subscribers has decreased from 10 million to 8 million. Same for their wireless subscribers. A decline from 8.5 million to 7.5 million. And that's quite bad. That's why the stock price has declined so much, over 90% from its peak. Moreover, also their net income has decreased. For the last quarter, Q3, they reported a loss of almost 140 million, a decrease from a profit of 400 million last year. So this business is not doing so great. Now let's look at their assets, because they have 53 billion in total assets. And as I said, of about 1.1 billion is cash. Now, if you look closer at their assets, what they have, the only asset I can rely on is their cash, as I said, of about 1.1 billion. Of course, they also have 7.2 billion in property and equipment, but if you look closer, you can see that most of their property and equipment assets are in satellites and equipments, which can become obsolete in a short period, between 5 to 10 years. Only their buildings and of course the land can last more. But if you compare those assets to their total property and equipment, it represents only a small amount of about 400 million. So their property and equipment are not a great asset to rely on. Only their cash their buildings, and their land. So if you add them up, you have over around 1.5 billion in assets that you can rely on. And compared to their market cap of about 2 billion, you might say that it's close to the stock price. But you might say that they also have FCC authorizations, worth of around 47 billion. Now the problem is, if you start reading more about FCC, especially those licenses, you'll find out that they have to be renewed. They don't last forever. And the amount that Dish has to pay to FCC is quite high. Every telecommunication company has to pay those licenses in order to broadcast their services. So you can rely on those licenses, even though they are worth over 47 billion. Now, this is not the issue. The huge problem is their debt, of about 20 billion. And if you look closer at their debt, you can see that the interest is quite high. And as the market expects no earnings in the future, because as you saw, their earnings have declined and they're expected to be lower in the future, I don't know how they'll be able to pay that huge debt of over 20 billion. So this is a huge problem. Even though they have some cash on hand of about 1.1 billion plus some assets, so in total 1.5 billion, you can rely on their assets because of the huge debt, over 20 billion. So the stock price is down for a good reason. Moreover, as they have so much debt and no earnings are expected in the future, there is another risk you have to be aware of, and that is possible future dilution. You can already see that the number of shares have increased a little, from 400 million to over 500 million. And this number may increase more in the future as they'll need more money to fund their business, because they have no earnings and they have to pay this huge debt. They also said in their reports that they need to raise additional capital in the future, which may not be available on favorable terms. That means the number of shares will increase and also their debt, if they can take on more debt. If not, then this company may go bankrupt. Moreover, you also have to be aware of competition. If you read more about Dish, especially their network, they are trying to build a 5G network via satellite, and they have a commitment that at least 70% of the US population has access to average download speeds equal to 35 megabits per second. So when you think of this speed, you might wonder why would you pay a subscription to get this service? And that's why the number of subscribers is going down. Moreover, don't forget there is also competition. For instance, Starlink. If you compare their speed, which is already available, you can see that Elon can offer a better speed, between 60 and over 100 megabits per second. And this is more than double to what Dish is planning to offer. And be aware that Starlink keeps improving its services. They invest a lot, they keep innovating, and this speed may increase even more in the future. Moreover, they still depend on other telecom companies, such as T-Mobile and AT&T. They can't operate alone. They are trying to promote their services, especially their pay TV, to bundle more channels and offer access to more streaming companies. But I don't know who wants to pay for this huge amount. They are competing with other streaming companies, which may offer other bundles, plus telecommunication companies, especially Starlink and other 5G players. So even though the market cap is around 2 billion and the PE ratio, according to Google Finance, is around 2, Dish doesn't seem to be a great investment at the current level. There is a lot of risk. Their huge debt, possible future dilution, and no earnings in the future. So if you want to take this risk that the stock price may rebound in the short term or in the long term, anything can happen, especially if they report positive earnings, the stock price will go up a lot. But if they don't, then you know the answer. The stock price will stay low for a long period. So it's up to you if you want to take this huge risk and focus only on the reward. As you saw, the future outlook of this company is not that great. There is a lot of competition they have a lot of debt, and you can rely on their future profits. And if you have any questions, please let me know in the comments.